um, and argue, and they love wedge issues, but I'm not sure if a lot of times they like actually getting things done. It was very interesting. You had uh, Hakeem Jeffries, the Democrat leader of the House, had like a 6 hour filibuster Thursday morning. And then after the bill passes, there's like every Republican leader is up there pontificating in front of cameras and getting their pictures taken. And it was just a really funny day if you don't love politicians, just seeing how little action was done. And it was more, how can we get in front of cameras, i.e., how can we get elected or reelected? And what was also interesting was as soon as the bill passed, the media narrative completely flipped towards how does this affect the midterm elections next November, 16 or so months away. And it was just a great example of for all of us that what do our customers see? Our customers, if they lean one way, we're really excited. And if you're on social media, you probably had some social friends on Facebook that were really excited about the bill that was passed on Thursday, signed into law on Friday. And if you have friends on Facebook that lean towards the left, they were very angry and very mad. And I talk about this a lot, but our job is to explain not like politically left or right or what the belief is, but what could happen. And I think anyone who's saying what they think will happen with this bill is just predicting or they're leaning one way or another, left or right. Because the reality is, nobody knows what this bill could do and what it could change and how it could affect real estate. Nobody's going to know this for many, many months. So I'll give you some high level stuff on what passed in the bill, what I think could happen, how we're explaining it to customers, and then we'll get into some of the other reports, the jobs report and the CPI. And then I've got some actually really good news. There's some trends that are really positive as far as not just the movement of interest rates based upon economic factors, but some other things, the spread between mortgage rates and the 10-year treasury in particular. Um, okay, so the bill. So you hear a lot of talk about of tax cuts, and there weren't really any new tax cuts in the bill. They were extensions of the tax cuts that Trump passed. So those in 2017 reduced many marginal tax rates, reduced some tax rates on corporations, and President Biden could have changed those, but the tax cuts in 2017 were positive. They were stimulative of the economy. Less taxes, people had more take-home pay, they're going to spend more money. That'll cause economic growth. And so I think the reason why you didn't see Democrats when they had control post-COVID get rid of these tax cuts is it would have hurt the economy if they raised tax rates coming out of COVID. And so the tax issue is more or less
Yeah,
an
that's the
extension
phone done
of
ringing.
policies that were already in place. You heard a lot of Trump's campaign promises of no tax on tips, no tax on Social Security. Those sound good. It's a good soundbite. I'm not sure how big of an impact it has. For seniors, I think a bigger impact. Um, if you're a senior and you have some investment income, retirement income, you could pay taxes on Social Security. And so that I think will go away. There's a lot of gray area kind of remains to be seen how that's going to actually, impact. But it's a good talking point. I'm not sure logistically how or when that gets implemented, but not a whole lot of new tax changes, just extensions of previous stuff. Um, on the left, they're very against this bill because there was some spending cuts, and a lot remains to be seen on how those are implemented, and it pushes certain things back to the states. Um, I think big picture, all of us should take a wait and see approach. Um, People are projecting that it may or may not add significantly to the deficit. We're already headed down a really bad path with $1 trillion deficit. Um, and so I think Trump's belief is that lower tax rates stimulate the economy. Economic growth means people bring home more money, they're making more money, they spend more money. And his thought is let's grow our way out of a slow economy. Remains to be seen if that works and what happens with that. So, but I think all of us should kind of stay down the middle. Don't get too far one way or the other with this bill. I think the advice we should give to our customers is I don't think it has a big impact on real estate. Let it play out and see what the bill does, economically. Is it going to stimulate growth or not? Remains to be seen. Um, There was one deduction that was increased, and so some of you have heard about the SALT. That's the state and local tax deduction. And so if you look at your tax return, the first page of your tax return shows your adjusted gross incomes. That's your W-2 income or your dividends or Social Security, or if you're self-employed, Schedule C or Schedule E. That's on the first page of your tax return of your 1040. The second page is where your deductions are listed. And the standard deduction you can take, that's around $25,000. Or you can itemize your deductions if you have mortgage interest and property taxes and things like that. When the bill was passed in 2017, the state and local tax deduction was $10,000, and that was quadrupled. I think they pushed it to $40,000. In 2017, the people that were impacted most negatively, and again, this was a Republican bill in 2017, Trump's first term, were people in big cities, blue states. So think about what states or cities would you have more than $10,000 of state and local taxes? Probably not in Florida 8 years ago, but certainly in high cost cities like New York, LA, and Chicago with state income taxes and high property taxes, you could very easily pay more than $10,000 in state in taxes and property taxes. And so that $10,000 cap, it hurt people in northern higher cost states that have a bigger state income tax. It didn't really affect us much in Florida or most of the South or Southwest because many of those states, if they have state income tax, it's smaller and our property taxes tend to be a little bit cheaper. But what's happened to real estate prices in Florida and in the whole country the last couple of years? They've gone up significantly. Therefore, what have property taxes done over the last couple of years? Property taxes are higher because they're a percentage of the home's value. So the state and local deduction actually helps us in Florida now because there's more and more people who are buying more and more expensive homes that have higher property tax bills. So, from a real estate standpoint, that could be a little bit of a win for those of us in Florida, which I think there's a lot of us on the call today. That if the state and local deduction where you can write off taxes went from 10,000 to I believe it's 40,000 in the bill, that could help us in Florida. So, outside of that, not a huge impact on the bill from a real estate standpoint. It's really just, your typical left versus right talking points. Let's argue about everything. But remains to be seen kind of how things play out. So while that was happening Thursday and into Friday, we had a jobs report on Friday. So I'm going to share my screen and we'll get into more of the specific economic data. So Friday, we got a jobs report. Earlier in the week, ADP, which is the huge national payroll company, they have their own jobs report. It gets released on the Wednesday of jobs report week. So Wednesday's ADP, Department of Labor is Friday. And the ADP report was very, very weak, and the mortgage bond market rallied. And Friday's jobs report, it wasn't strong. It was slightly better than expectations, which has kind of been the trend over the past 18 months, which is weaker reports, but maybe better than expectations. Um, but the ADP report showed there were 33,000 job losses, and the jobs report in June was 147,000 jobs gained, which again, that's not great. That's like a C minus if we're, kind of using an analogy of like grading it. But it was better than the 110,000 jobs that were expected. And the market reacts in anticipation of what they think the news will be. If the news comes out and the news is different than expectations, there can sometimes be a knee-jerk reaction. So um, a bunch of us on this call that are out on our team at Cross Country or friends in the mortgage business in other countries, we're all texting each other feverishly Friday morning, like, can you believe it? It beat expectations. And every single one of us was fearful that you would have seen mortgage rates spike as soon as we saw a positive jobs report. Um, the good news is that we really didn't see a spike in interest rates like we all feared at 8:32, 2 minutes after the job report was released. You saw a slight sell-off in mortgage bonds, but very, very, very minimal. And again, today, slight sell-off in mortgage bonds, very, very minimal. But it kind of feels like we dodged a bullet a little bit because you can see we've been on this great run here for the past 45 or so days. Um, Rates flattened out a little bit last week. Friday and today, rates sold off. Bond market went down. Rates ticked up a little bit, but not enough where your clients are even going to notice. Not even an eighth of a percent movement in interest rate. Um, but feels like we dodged a little bit of a bullet because it could have been worse. There's been some very, very knee-jerk, violent reactions to better than expected jobs reports over the last 18 months. And so we got a little better than expected report, but the market didn't react. And I think the reason why is twofold. Why did the market not react negatively to what could be deemed a positive jobs report? So one is um, the Department of Labor is kind of turning into a little bit of the boy that cried wolf. If you guys remember that story from when we were kids, right? Every single month, the numbers come in higher than expectations, and then in future months they're revised lower. And so the market is really taking these reports with a grain of salt because they've been relatively inaccurate over the past 18 months. If you remember on prior calls, we talked about in 2024, just for the calendar year, the Department of Labor's initial number was overstated by 1 million jobs for the year. Or another way to put that is they averaged overstating it by 80,000 jobs every single month. It's a little bit better the last few months, but still the market kind of feels like let's take it with a grain of salt. Let's see what happens in future months. Is that 147,000 number? Is that real? The second reason the market didn't really negatively react is where the jobs came from. And this is a breakdown of where the jobs came from. And this really shows that there's certainly some weakness in the jobs market. We've talked about it, we've seen it. It's been the case for the last couple of years. Um, we're not contracting, we're not in a recession, we're not going backwards, but we're not making up much ground either. Um, 73,000 jobs of those of the 140 created were government jobs. Um, 58,000, so close to 60 were healthcare. And if you look at other segments of the economy, financial services, retail, so retail was basically a break even. That's an indicator of the strength of the American consumer. If we're not spending money at retail stores, the retail sector is not growing, that's kind of a sign that the economy's slow and, kind of, tread water, if you will. Um, and then troubling is we lost some manufacturer jobs last month. So I think part of the reason why the market didn't react negatively to a better than expected jobs report is they don't really trust the numbers, one, and two, where the jobs came from. It wasn't sectors that are growth sectors. If we jump back into the charts here. So there's two surveys that are used. There's the household survey and the business survey. The business survey is where they get the unemployment rate from. And the unemployment rate has been trending higher. It went up to 4.2% last month, and most people thought it was going to be 4.3. It actually went down, if you're sharing my screen here, to 4.1%, but it went down for the wrong reasons. It went down because 130,000 people left the labor force. So the household survey showed that there were 93,000 jobs created. 133,000 people left the labor force. That's why the unemployment rate went down, is fewer jobs, but fewer people working as well. So overall, did it beat expectations on the headline? Yes, it did. If you dig into it, there's still signs of weakness. And one positive from the jobs report was average hourly earnings. If average hourly earnings are increasing and increasing significantly, then you can get into something called wage-based inflation. So inflation through higher wages. And average hourly earnings was up 0.2%, a little bit less than expectations year over year, 3.7% wage growth, less than expectations. So that's a positive sign for inflation. So big picture on the jobs report is headline was better than expected, but the reality was it was probably similar to the trend we've seen the last 12 to 18 months, that not terrible, a little bit weak, probably a C minus if you're grading on a grading scale. Um, okay, all of that said, the CME, who gives the prognostications or predictions of the next Fed rate cut, And this is similar, the July 30th meeting, 95% of those polled expect no rate cut. The market has priced in no rate cut in July. But we've talked about this a little bit over the past few weeks. In September, the meeting after the next one, we were up to about 80%, I believe, last week, expecting a Fed cut. That's down to 67% now. So a little bit of a positive jobs report has people less expecting a Fed rate cut in September. Like I mentioned on these calls very frequently, that number is a moving target. That's going to change tomorrow after the CPI, and any economic report that's released is going to move that needle. Give me one second. I got someone muted here. Let me get the background noise cleaned up. Okay, there we go. Um, if you guys don't have this, this is a kind of a cool tool to watch. I'm going to pop this in the chat here and just grab this link when you can. And after a market event like a jobs report or consumer price index tomorrow, jump on this Fed CME and look and see how the predictions change. A lot of talk from the president about wanting to get rid of Jerome Powell, wanting interest rates lower. I would expect that to continue. He's going to continue pushing that rhetoric. Trump really wants rates lower. And he wants rates lower for things that we talked about back in January, February, and March of this year, which is we have to get interest rates on the 10-year Treasury down because of the amount of government debt that we have, $30 trillion plus. Um, Reducing interest rates, reducing the 10-year Treasury will take our interest expense from north of $1 trillion. There would be some relief there. So I'd expect Trump to continue pushing hard. Not that Jerome Powell is going to resign, not that Jerome Powell is going to make any adjustments based upon what the president tells him to do, but I think Trump's going to continue putting pressure on him to lower interest rates. But I don't think we're going to have anything happen until September, and that kind of seems to be what most experts expect as well. Okay, if we look at the economic reports of this week, so the big ones tomorrow, the consumer price index, so 8:30 tomorrow morning, turn into CNBC or Fox Business. They'll release the CPI for tomorrow. We want to see it trending closer to 2%. If we continue trending lower, which we have been most of the past couple of years, we had a little bit of a spike last fall, but overall inflation's trending in a positive direction. That would be good news for interest rates. And so we get that on Tuesday. The producer price index, which is inflation at the producer level, so think the manufacturer and the business, that's released on Wednesday. That typically gets less attention. It'll be really interesting to see what the PPI, the producer price index, does on Wednesday because it'll start to allow you to see if companies are who import goods are passing tariff expenses on to consumers. So if companies are eating some of those costs and they're not passing it through to consumers, you might see it in the PPI, the producer price index, but you might not see it on the CPI, the consumer price index, if companies are making less profit. So for example, let's say Walmart imports some good or service, and let's say there's a 10% tariff on that. If they pass that full expense onto the consumer, that would be inflationary on the consumer price index because the consumer would feel the increased cost. Let's say they eat half of the cost themselves, they have that cut into their profit, and they pass half to the consumer, then you would see it impact the consumer price index to a lesser degree, but it could impact the producer price index a little bit more. So something to watch. People don't typically follow the PPI as much as the CPI, but we'll be watching that one to see what happens. But again, the trend is positive in inflation, so we should get some good news this week with interest rates as long as we get a good number tomorrow. Okay, so I mentioned a couple positive things. So one, so this is the Mortgage Bankers Association Weekly Purchase Index. I've shared charts of this index before where we compared 2025 to 2024 and 2023 to show that the index of applications and activity was exceeding the prior 2 years. That's a positive sign. It feels like the market's busier. I know our team at Cross Country had a record month in June. and it doesn't seem like things are slowing down. It seems like as a team, our group is like really, really busy right now and probably going to set a record in July, and August looks good already. So I think all of us who are kind of still standing in the real estate and mortgage market are probably pretty busy right now. And the data tells us that's the case as well. So the mortgage application index, it has increased for 22 consecutive weeks, going back to March. And this is seasonally adjusted. But essentially, what this means is that purchase, not refinance, but purchase activity that this measures is positive and improving. Um, and it's not drawn to scale 150 to 190. So, it makes it look like it's a bigger increase than it really is. But incrementally, we're seeing a little bit better news, a little bit more applications every single week. And some of this is really in the face, like if you look at March and April when interest rates spiked. So even with higher interest rates. Okay, and on the topic of interest rates, so here's the good news to share with you guys. So um, historically, there's a spread or there's a difference between the interest rate of the 10-year treasury and 30-year fixed rate mortgages. And the reason there's a spread is if I am buying a treasury bond, a government issued debt, that is a safer, less risky investment than if I'm buying a mortgage bond or mortgage backed security. Just like the return on a stock should be higher than the return on a CD, it's higher because of risk. It's riskier to buy a stock than it is to buy a CD that's got a guaranteed rate of return. And I should be compensated for that risk with the potential higher returns of buying a stock or mutual fund. And bonds are the same way. Treasury bonds are safer, less risky than mortgage bonds. If I'm an investor like a pension fund or 401k and I buy mortgage bonds, I should be compensated for that greater risk with a higher yield or higher premium. And why is there greater risk with mortgage bonds than treasury bonds? Um, Up until the last couple of years, there wasn't a lot of fear that the US government would default on their debt. And to this point, we never have. Hopefully, we never do. Um, when we had our credit rating downgraded a few months ago, one time it happened in about 10 or 12 years ago, and another time a few months ago, that makes treasury bonds riskier because the debt rating is downgraded. And so the 10-year treasury would hike up there. Um, but the default rate on mortgages is certainly higher than on US Treasuries. And so there is a greater risk for mortgage bonds. And so the chart here is the spread, the difference between the 10-year Treasury and 30-year fixed rate mortgages going back to the 1990s. And so we've got about 35 years worth of data. And you can see that typically mortgage rates are somewhere between 1.25% and 2% above the 10-year treasury. Okay, so if the 10-year treasury was 4.5%, that would make mortgage rates 5.75 to 6.5 in that range. Um, you can see in times of economic uncertainty, the risk of investing in mortgage bonds goes up. So think financial crisis. All these gray lines are recession. So financial crisis and COVID. Okay. So you saw that spread widen where mortgage rates were higher than the 10-year treasury by a greater than normal or historical margin. You saw it spike to 2.5%. Look where the spread has been over the past couple years, almost 2.5 to 3%, way outside the realm of what's been historically normal. So over the past couple years, mortgage rates have been somewhere between 0.5 and 1% higher than they probably should have been because the spread between the 10-year and 30-year fixed rates has been greater than we've seen historically for the past 35 years. The positive news is that spread is starting to shrink. Um, in fact, it's less today than it was in 2024 and 2023. It's still north of 2%. It's around 2.25. And so if the 10-year treasury is around 4.5, you add 2.25 to that, 6.75, and that's about where mortgage rates are. Okay. And so how can we see mortgage rates move down and move down meaningfully? All of the economic indicators we talk about, the jobs report, inflation cooling, getting beyond the tariff fight, That will all bring mortgage rates down just based upon economic indicators. As the spread between the 30-year fixed rate mortgage and the 10-year treasury shrinks and gets back to a normal range, that'll bring mortgage rates down as well. And so if you can see mortgage rates, that spread get closer to 2%, which would still kind of be on the higher end of where that spread's been for the past 35 years, that brings mortgage rates down below 6.5. If the 10-year treasury drifts into the low fours, and we've gotten there a couple times this year, that brings 30-year fixed rate into the low sixes. And so this is one of the reasons why we've talked about we feel like lower rates are ahead, both for economic reasons, jobs, the economy, inflation, but also the spread between the 30-year fixed rate mortgage and the 10-year treasury. Um, that spread escalated post COVID because the risk and fear of mortgage defaults. But you really haven't seen a significant increase in mortgage defaults. There's not a run of foreclosures. And so that's one of the reasons why that spread shrinking. So if that continues to shrink and inflation news is positive, then you see rates pushing below 6.5%. And we got pretty close to 6.5. We locked in some 6.6s last week. FHA certainly there, but you'll see that trend move lower. Just to give you an idea, and this is kind of from an affordability standpoint, if someone took out a mortgage for $400,000 at 7%, their principal and interest payment would be $2,600. If that drops to 6%, it's about $230 a month or about $3,000 a year that it saves them in interest. So just from 7% where we have been at times this year to 6 where we could be over the coming months, and I'm not saying 90 days, but 6 months, 9 months, 12 months into the year, first part of next year, that's a significant savings and should be a significant pickup in affordability. So something to keep a close eye on there. Um, all right. I think I saw a couple of questions in the chat. I think you might have answered those, Aaron. Hometown heroes. Looks like the question was, yep. And so no news on hometown heroes for those of you in Florida. So I would expect something probably in the next week or two. They'll get through the 4th of July holiday and you'll probably see something formally announced. So with that, guys, it is right at 10:30, so we will get you out of here on time. Appreciate you jumping on. Have a great day. Have a great week, and we will see you guys next Monday. Thanks, everybody.